Hey, this is Wayne Wagner from Vizionar Wealth Management, and I thought I'd introduce you to Titus. Titus is a new member of the Wagner family, and he is about 4 months old now and growing like a weed. He has tripled in size in the 6 weeks that we have had him, and there he is. He's off and running. So Titus replaces our puppy Diamond, who was 6 years old and actually died while she was in a kennel while we were out of the country this past summer. So Titus is our replacement puppy, and he's growing like crazy. So let's get back to business. The Federal Reserve has announced that they are going to be raising interest rates a number of times this year, and they took the first step this past week to raise about 25 basis points. We're expecting anywhere from 4 to 7 or 8 on the high side, probably 4 or 5 total this year, where they're raising the federal funds rate. Now remember, the Federal Reserve only controls the overnight rate for banks. So they don't control what happens with the 10-year mortgage, a 20-year mortgage, 30-year mortgage. They just control the overnight rate. But what we've seen is that historically, as the short-term rate goes up, the longer-term rates tend to trend up as well. And what very often happens during long periods of very, very low rates is we actually get the Federal Reserve will raise rates, and as they raise rates, they actually raise rates on the short side higher than the rates at the long rate. That's called an inverted yield curve, when short-term rates are actually higher than long-term rates. And yes, there is a very, very high correlation between an inverted yield curve and periods of recession or periods of economic contraction. And in fact, that's exactly what the Federal Reserve is trying to do. Is the Federal Reserve is trying to control the growth rate on the economy, because there's a whole bunch of factors. Yes, supply chain and COVID related and so on and so forth, but there's lots of factors causing inflation and kind of overheating within our economy right now. So while most of you will remember something from school that says, hey, when interest rates go down, bond values go up, and the opposite is also true. When interest rates go up, bond values go down. That means the things that we've done historically to be safe, bond indexes, 10-year T-bills, things like that, are not going to be great investments for the time being, and really probably for the foreseeable future. Now, you might recall that if this is interest rates over here, and this is the length of your bonds, so if you have 5-year bonds, 10-year bonds, 30-year bonds, so on and so forth, that the changes in interest rates have a more impactful change on the valuation of your bonds. And so I want to talk about 4 things that we have already done and are already doing within your portfolio to preemptively protect and against the volatility associated with interest rate rising. So we use 4 different kinds of things in the conservative end of your investment portfolio to try to disassociate or disconnect or protect against the fluctuations in interest rates. Okay, so first of all, we use cash. So the bottom one down here is cash and T-bills. If you look in your portfolio, you probably see a position called GBIL. GBIL is a 1-year T-bill. You also have cash in your portfolio with us, and the cash levels have been running higher than typical. Why? Because we knew this was coming, and so we wanted to protect against that preemptively. We also want to have dry powder for fluctuation in the market so that we can buy. Second thing that we use is fixed index annuities as a portion of your portfolio. So for most of our clients have at least a portion of their portfolio in fixed index annuities. These are investment vehicles that have no internal fees and no downside risk. So even as interest rates go up, you can't lose money in a fixed index annuity because they're backed up by the insurance company. The 2 primary kinds of actual bonds that you have in your portfolio fall into 2 categories. One is high yield municipal bonds. High yield municipal bonds are bonds in municipalities that are traditionally having some kind of disruption or issue. And whether that's Detroit School District or Puerto Rico or Orange County, California, but they're typically municipalities that are very, very cash strapped and having issues. The reason we buy those bonds is because we buy them while they are in crisis, and then we hold on for a while the municipalities go through the process of fixing things. So we usually have them bought at significant discounts, and the improvements of what's going on and how those things work through are not directly related or correlated to interest rate changes. The last thing I'll touch on here is floating rate bonds. So floating rate bonds, if you think about the length of your bond and how much movement you have, well, if this is a 30-year bond, floating rate bonds have a 90-day duration. So floating rate bonds actually change. They adjust their interest rate because it floats with the market every 90 days. And so while we get typically very, very low interest payouts on these, although we've typically been doing 3.5% to 4.5%, we're typically getting relatively low interest rates on these investments. We don't have the long-term fluctuation associated with interest rates. And so those are four actions, four positions that most of our clients own at least a little bit of across your portfolio, where we're preemptively taking action to make sure that you are not fully exposed to interest rate raises, which are now happening. So if you have questions on this or anything else, please call us at any time. We're always here with perspective for the decisions ahead. I need to go make sure that Titus is not chewing someone's shoe. Have a great day.